72T payouts or a substantially equalized payment periods, periodic payments, that's what it is. Substantially equal periodic payments. SEP, S-E-P-P, not SEP IRAs. I get this question so much. We're going to read an article from another subscriber sent this to me. It's a good article, actually, which will clear it up if you're wondering. I'm just not a fan. I haven't seen these work nearly to the extent that financial advisors offer them at all, actually, and I'm not a fan of them. But to each his own. But let's dive into it here. Subscribe. Are you? So just the question I'll ask you: are you familiar with 72Ts? Just put a yes or a no in the comment section. We're doing that for the algorithm, frankly. So if you're familiar with 72Ts and you put a yes in there, it's not that I'm going to email you about it, just because it does help with the algorithm from YouTube. So if you want to help the channel, a smash and a yes or a no to the question, if you're familiar with 72Ts, is helpful. So, all right. Moneycrashers.com. I've never heard this site, but almost 19,000 people have viewed this article. And I don't see a dateline on here, so I'm not sure what the dateline is. But here is the author, is Kira Botkin. All right, Kira, let's see what you got. But again, a subscriber sent this to me, so I thought it'd be interesting because I do get this question a lot. So what are 72T period distributions? Excuse me. If you're lucky enough to retire early, you may run into a little snag when you try to withdraw money from your IRA or 401k. You'll be charged 10% penalty before taking out before the age of 59 and a half. Just remember, and look, post 55, you're not, or post 40, 54 in a 401k, once you separate from service after the age of 54, you're not charged at 10% early withdrawal on your 401k, which is why you don't want to roll a 401k to an IRA if you're going to tap in the money soon before 59 and a half. Don't do that. If you retire 54, you can't have access to your 401k at 55 without 10% penalty. You separate from service after 55. Remember, first responders, law enforcement, EMTs, Border Patrol, FBI agents, a couple other groups there. It's a separation after 49. They have access to their employer plans without the 10% penalty, as long as it's not rolled into an IRA. So just keep that in mind. However, one way many early retirees get around this is by withdrawing specific amounts of money in substantially equal period payments, or SEP, known as 72T in the IRS code. It allows you to withdraw money without getting the 10% penalty as long as you adhere to specific rules set up by the IRS. You can choose one of three different methods to determine how much to withdraw and stay within the rules. Required minimum distribution method. This is based on your life expectancy or the joint life expectancy of you and your beneficiary, and your account balance as recalculated every year by the IRS. Fixed amortization. This method bases your payment on the account balance and a specific rate of return. Even if your account outperforms that rate of return, you still withdraw the same amount. Or a fixed annuity payment. This uses an annuity factor from a mortality table with a reasonable rate of interest to calculate the fixed payment. It seems like it's been a long time since I've done any of these 72Ts. Seems like we would do, I can't remember, an annuity. I think it seemed like an annuity. We had a fixed, or is it amortization? We just had a fixed amount. I can't remember. But anyway, let's keep reading. Choose a calculation method that best suits your needs, whether you want to get the most money out now or preserve your account for later. The RMD distribution method will generally allow you to withdraw less than the other two, and since it's recalculated each year, you'll be protected from withdrawing during market declines. Fidelity's got a tool that you can use to calculate your withdrawals under the amortization or RMD methods. Keep in mind that if you withdraw too much money, the IRS can treat it as an early withdrawal and thus assess you the 10% penalty on the extra amount. And this is what I always didn't like. It may help to have an accountant double check your figures on a regular basis to make sure you won't be penalized. I never saw that happen. That's the thing. All these financial advisors saying 72T, and they don't know what they're talking about. They're just using some freaking thing from Fidelity and says, well, this is what Fidelity says. Well, Fidelity's just a website, man. They got no liability to you. And I'm always remember saying, like, it'd be some guy from Ed Jones, or there's another firm too, Primerica or something like that. And I was like, they don't even know what they're talking about. You're going to do this 72T, and you're going to take the money out in advance, but you don't know what you don't know. And what you don't know is the guy from Ed Jones or whatever, Primerica, Thrivent, they don't know either. And so they're just using this tool from Fidelity. And I said, have you run it by your accountant? Because we need to make sure the accountant's on board here, because if you screw this up, it's 10% penalty. Not just on the money going forward, on the previous money too that you withdrew under the SEP rules. If you start right here, if you start a SEP plan and want to change the calculation method, you can do only once. And if you're going to from one fixed amount to the RMD method, otherwise all your previous payments will be declared invalid and hit with a 10% penalty. So be careful. That's what I'm saying. It's like if you screw this up, you're not just screwing up going forward, you're screwing up for what you did in the past. A SEP must be in place for at least 5 years or until you turn 59 and a half, whichever is longer. So if you're 58, you got to wait till you're 63 to stop it. You know what they say right here. If you're 58, you have to continue until you're 63. Consider if you really need the money for all 5 years, especially if you're near retirement age. You'll be getting a pension or a Social Security check soon. Remember, even if you don't need them, you'll be forced to continue taking payments for 5 years or face heavy payments. Smash. I like that. I did that. And smash reminds me to tell you smash. However, if you're happy with your SEP 72T distributions, you can continue them indefinitely. Depending on the method chosen, minimum distributions from a SEP will be equal or greater than RMDs once you turn 70 and a half. So you can continue going on. It'll match your RMDs, so you're fine. Taxes, SEP withdrawals are taxed. If you withdraw from a Roth IRA under a SEP, you'll be taxed on those distributions as well. Ordinarily, Roth distributions aren't taxed as long as they're after 59 and a half. The 10% penalty is waived with a SEP, but not the requirement that you pay income tax on earnings before you hit 59 and a half. Contributions that are at least 5 years old can be withdrawn at any time for any reason without being taxed or assessed. So I always tell people, look, if you need the money, you're 57, so we have a Roth, we can take the principal out first. This is one instance where account diversification, having more than one time a retirement account can be beneficial. Exactly. If you have a Roth, you have a traditional, you have a 401k and a Roth 401k. I completely agree there. Another consideration is that since your SEP withdrawals will increase your taxable income, they can affect the amount of Social Security income tax. See, that doesn't make any sense because you're not going to take your SEP the only reason you're going to take a SEP is because you're before the age of 59 and a half. Makes no sense to do a SEP, a 72T, after 59 and a half. Makes no sense at all. So you're only going to do it at 59 and a half. So the only way to affect your Social Security before 59 and a half, the only way you'd affect your Social Security is if you did it like at 57 and you had to do it to your 62, then you start taking Social Security. Or you did it at 58, and then you had to wait till you're 63 to stop, and then you took Social Security at 62. So if you're doing a SEP at 55 or earlier, it's one thing. You're not taking Social Security. If you're doing a SEP, again, a 72T, not a SEP IRA, at 58, I tell you, no, let's not do it. Let's find some other method to get your money. Talk to a CPA to see how it impact your taxes. Completely agree. All right, so other guidelines. Payments must be made from the account at least once per year. They can be made up to once per month, but every single payment needs to be equal. Once you start a SEP, you can't transfer money or take distributions from the account other than that 72T. I didn't know that. Again, it's been a long time since I looked at this because I didn't pay much mind to it when I was a broker, and I haven't paid much mind to it since because I just don't think it's very valuable. You can't start a SEP in a 401k with a company you still work for. So if you're still there, you can't start it. And again, I just say just wait till you're 55 and then separate from service and take it out then. Let's see. You must choose how much to withhold from your SEP distribution for your federal taxes. You can even choose to withhold nothing if you want to. If you don't choose anything, it'll automatically withhold 10%. Make sure your financial company is withholding enough so you are making estimated tax payments on a quarterly basis. Yep. What if my SEP distribution is more than I need? Do some prep. Yeah, exactly. They're saying do some prep works to make sure you don't take out more than you need. After all, you don't want to give up tax deferred growth if you don't have to. I don't know about that, but use a calculator to determine how much you need in your account to get the amount you want to withdraw. Transfer the excess money to another IRA and then set up a SEP with the original. That's going to be too complex. So anyway, I'm just not a fan of the SEPs, generally speaking. The 72Ts, let's see, comment. What if the IRA account that is having 72T automatic withdrawals come from is depleted? Do I need to notify the IRS that it'll be depleted and to stop the automatic withdrawals? I don't want insufficient. Well, if it's depleted before you did the 5 years, you're gonna have a problem there, man. That's a fact. I don't know what they do, but the IRS says it's got to be 5 years. 5 years. So if it's depleted, if there's no money before the 5 years is up, That's going to be a challenge. So I'm not a fan. I'll let you determine this. I would absolutely highly encourage you to seek tax advice, not just rely on the calculators from Fidelity and whatnot. Well, because just like this guy said, I mean, what happens if the account's depleted before the 5 years up because you invested incorrectly or something like that? I don't know how that works, but you don't want to be messing with the IRS. You don't want to give the IRS any red flag at all. Just don't do that. Again, that's why the tax diversification. I have a Roth over here. Look, I need the money. I'm 58. I don't want to tap into my IRA. I'll take it from the principal of the Roth and wait until 59 and a half, and you're golden. All right, we'll see you next time.